going on, everybody? Michael here. Welcome to the Stock Market Brief Show. The markets are on absolute fire blasting mode since we got the election results. You can see that in the 11 sectors. Financials led the way over here. We had the Dow Jones up a whopping 3.57%, 2.5% in the S&P 500, almost 3% in the NASDAQ. Mid caps and small caps saw a monster move as well. Today's episode is going to be a little bit shorter. These last couple of days, I haven't been really able to put out an episode. My child's been sick, so I'm going to try to make this one here as quick as possible. And I do have some help coming in tomorrow, so I'm going to try to live stream. So if you are available to watch a live stream, we do have the Fed event, so I'll be trying to live stream that while that is going on. So overall, let's just really kind of dive in and see what's going on with these markets. This is the initial reaction of the market, right? Now, I really want to answer a couple of things here, and the main things I want to answer is, one thing is going to be like, okay, what if I missed the move? What do I do, right? And what if I made the move? What, should I take profit? Should I update stops? Should I add more exposure? What the case may be. And I know it's going to be a case-by-case basis, but I can really kind of explain it through the lens of what it is that I do, how I kind of navigate this stuff, and really what we've been talking about on this Stock Market Brief Show. On one of the prior episodes, we talked about not only the expected move, but the market conditions. And when market conditions change, we typically add more exposure. And leading up to the election, well, my hand was a little bit forced, right? So if you follow me on Twitter, you probably saw the post where I said my hand was, I didn't feel comfortable adding more exposure into the markets, into an event that had a gigantic implied move. But that's what I had to do because that's what the market was kind of forcing my hand to do. We saw a strong day leading up to elections. And, lucky for me, it went in my favor. A few episodes ago, we talked about the poly market and how the poly market, which actually, interestingly enough, was more accurate than the polls themselves. So the predictive markets, the gambling markets. And I just found it very weird that so many people gave me such a hard time for taking 13 seconds to show that, to go back through history to see what has happened in the past when Donald Trump was elected. Like, who cares who's elected? We're talking about money here and managing money, right? Like that's the main goal here, is to preserve and protect our capital. So we got to use the data that we have. And well, it's a play from the playbook. Like, you go back to the last time he was elected, the market's ripped. And what happened today? The market's absolutely ripped. Like, if you just go back to that video, like I said, I only talked about the poly markets for 13 dang seconds and people lost their freaking mind. It's honestly pathetic, in my opinion. And their bias is obviously showing. And for me personally, I don't have that type of bias. Like, I don't care, right? I care about my family. I care about preserving and protecting my capital. That's my main focus. And if I'm going to make these wild narratives and just ignore data, then you'd be in the wrong business. That's just the reality of it. So the market reacted positively. But it is a very interesting type of move in the markets, right? Like, what has the market been telling us, right? The 10-year yield has been rising. The dollar's been flying, right? We've been wondering, what's the market trying to tell us? Perhaps the dollar move here is and has been telling us that this is going to be a Trump presidency. Why? Well, because, currencies are global. And one of the things with Trump is tariffs, right? So this huge move could be pricing that type of thing in. Now, what's up with the 10-year yield? You typically have these negative correlations where you have a rising 10-year yield, rising dollar. It's not good for the markets. So another thought here is, this is the initial reaction, but what does the digestion of the market look like? And I think, before getting overly excited that the market's going higher and, stronger, whatever the case may be, I think that if you manage to get some of this move, like for example, I did, I definitely walked into this not thinking that the markets were going to respond like this. The regional banks were up, they were up 12% or 13% on the day. The last time we saw a move like that was in November, the same time, it was November 9th, it was 2020. We saw it move up, 12% in a day. And, 89 trading days later, the thing went up 50%. So we'll see if we're going to get a same reaction, but I will tell you that the conditions of the market are different, right? We're in a tightening cycle right now, which is a lot different than was back there in 2020, going into 2021 too, right? We had the Fed bazooka. So I'd be very cautious and just aware that like bond market, how it's moving right now, if the 10-year yield keeps flying up higher and the bond market keeps coming off, that's just a very, very interesting environment. So like I said, we'll go over expected moves, weekly expected moves, what the market's looking at like, but just be aware of these assets that are incredibly important to markets. There's talks about inflation coming back, and while we've been seeing that kind of in the data, Fed decision, it lurks in the shadows. We'll be live tomorrow kind of streaming that. It's going to be going around 12 p.m. That's Pacific Standard Time to 12:30 was the press conference. Like I said, I can't guarantee that I'll be live, but that's the goal there. So I want to hop into expected moves because the expected moves going into the presidential election were freaking insane. They were like $8 per, a plus or minus on the SPY, and we opened outside of the expected move. Right, this was for yesterday, or this was today's trading session, but the expected moves for the day. And sometimes that I've noticed throughout history is when we start outside of these expected moves and they come back, they can actually flip and potentially act as levels of not necessarily a support. I mean, it does. I mean, it was literally to the T. It gapped up, came in, and then started bouncing from those levels. But when you get the markets this wrong, right? When the whole market prices in an expected move, and they get it completely wrong, and the market moves outside of it, well, they need to correct and change up what they currently price in, right? Readjust, reassess risk. And the market came back into the weekly expected move, the daily kind of expected move up here into the zone, and it flew absolutely higher throughout the trading session. Now, I'll go over, the kind of areas of interest, but I wanted to show you just how incredible of a move this actually was. If we look at the Qs, the very same situation. It came into the weekly expected move. Boom, we pull back into the daily expected zone. Now, I didn't make a video yesterday, but I did post in the community a link to my link to my X account, and I showed all of these levels there because I just like I said, I couldn't make a movie, and I'm pushing it tonight myself. Okay, and then the market started ripping from these areas. If we go over to the IWM was up like 5 or 6% on the trading session. It's outside of its monthly expected move, right? It's only November. This is the quarterly expected move, and we're not even too far from it. And this was the daily expected move. So we're talking 2 standard deviation moves. The market got it completely wrong as far as levels of risk go. Doesn't mean that we can't see these things come in, but just be aware of just how powerful of a move it happened to be. Now, let's take a look at the updated levels. Now, you can screenshot these, put them on your chart to understand, because remember, if we're thinking in terms of probabilities, right, 68% of the time it's going to land within this range. And if you're long, you might be able to play it into certain key levels like intraday, or lower levels, maybe look for areas to buy the dip, whatever the case may be. Now, from a probability perspective, we're looking at the weekly expected move. And I know I've already been asked, if it's outside of the weekly expected move, are you still confident it's going to come back in? And well, yes and no, right? So there's a higher probability, right? This is a huge weekly expected move, by the way. It was plus or minus $15. It's wild. We haven't seen one like that for a while. So it's been tagged, it's been hit. Now, 68% of the time, typically more actually in the S&P 500, more like 75 to 80% of the time, we close within the weekly expected move. So the higher probability is that we come down back into this area. Now, does that mean that I would short this into here? No, because I don't really care about catching a move from here to here or maybe even here to here. I just do not want to focus on that after seeing the strength that we just saw. I would prefer the market to digest instead of try to catch every single move that I can. I'm primarily a swing trader, breakout trader, and I focus really primarily on trend trading. And the trend is up, right? On many different time frames, the trend has been up. So the reason why I'm saying this is because people that miss the move, they may want to overcompensate by saying, okay, well, since I missed this move, I want to catch the move to down here. And it could work out. It could not work out. If you were to approach it that way, I would just say, just make sure that your risk manage it, meaning your position sizing, right? Your position size and where your stop is going to be makes sense, because you'll be going against the river, right? The river's flowing up and you'd be trying to kind of like go against that. Now, if we do start coming back in, the anchored volume weighted average price is right over here, going from the low of today's trading session. So if it does pull back in, see what it does in and around that area. And then also just anchor a volume weighted average price from the high of wherever that may be, because it might kind of pinch around and then set itself up for some continuation. But usually when we have this strong of a day, we can very well see some follow through or a new high going into the following trading session. So into tomorrow, our upper monthly expected move levels, our lower daily expected moves, and back into the weekly expected moves are right there. I'm not going to read them out because you can just screenshot them. If you take a look at the Qs over here, the Qs upper monthly expected move, the daily expected move, as you can see, in the same situation goes. We're not really that far out of the weekly expected move. But on the daily time frame on the Qs, we did see a pretty solid breakout. And now I'd just be watching to see how this digests, if it comes up more, or digests, chops around, whatever the case may be. And then we have the IWM, which is just on monster tear. And sometimes when you get huge moves like this and things like IWM, you can get these lockout rallies where they just like don't stop for like 2 or 3 days. And it just goes boom, 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 right? And then people freak out. I would still, in my opinion, would be hesitant. And I would just be waiting for smaller consolidations on the lower time frames to see if something sets up. So I'd be looking at the anchor volume weighted average price from what looks to be an earnings, but it wasn't. It was just the presidential election. And I'd be looking for pullbacks and consolidations and then anchor from the high and then see how it works from those places. And then you could watch these daily implied moves for potentially playing intraday into and around those specific levels as well. We're way outside of that weekly expected move there too. Okay, let's look at market conditions. Now, what forced my hand to go long? Well, it was the gamma. It was the gamma flip line. We started getting back into positive gamma territory the night before the elections when we saw that pretty bullish day. So, and we were back above the 5-day moving average, albeit it was declining. So I started adding in to some setups that look pretty decent, like ticker symbol AON, FFIV, Google. I had a little bit in ISRG. I had XBI. So those are some of the names that I posted in my trade ideas in the Discord. There's a link in the pinned comment or in the description. But I've been really light, right? I really haven't been posting too many trade ideas recently. Because the market conditions were a little choppy. They were a little all over the place. The implied moves were big. And then, right, as soon as we started seeing a little bit more positive moves, I looked at some names that already went through earnings, right, and started consolidating. And they played out decent today. And I got to, scale some of those out. Now, if I'm looking at a net gamma chart from a market condition perspective, this is 6,000. Now, if you go back to my prior videos, you would have heard me saying that when we were floating around, what I would like to see is a move down to 5750, maybe potentially lower, bounce around, and then come up to 6,000. It seemed a while ago that traders kept on reaching out here that we were going to 6,000. This happens to be the call wall. It also happens to be where JPM has their collar, right, just past 6,000. So this could bring an area where price once again gets kind of pinned and chops around at. If you take a look at the net gamma chart over here, 5950 is a decent level. And then you have that 6,000, which you currently have about 165 million as far as gamma exposure goes. If price were to come back into these areas, it would just be coming back into an area where we saw a lot of different chop before. So, right, we saw this, we saw the breakdown to that 5750, 5700, and boom, we saw that explosive move. So as far as market conditions go, we are above a gamma flip line. That's check for the bulls. All right. If you go over here, the SPY, the Q, the IWM, you could see the day prior, we started getting back above the 5-day moving average. This was already there. Back on the Qs, IWM, it was the same situation and so forth. And then we had a pretty nice follow through. So everything's above a rising 5-day moving average, but it's extended. So if you miss the move, you got to be a little patient here. If you manage to catch the move, make sure that you're updating stops or updating your risk parameters that fit you, right? So for me, I just took a little bit off because of the volatility that took place in today's trading session was pretty gigantic. So by reducing some of that exposure that I have in the markets after a move like that, it's going to reduce the amount of volatility in my portfolio if the SPY or the Qs or anything like that were to come back in pretty significantly. So that's all I really got for you on today's episode. Everybody tune in live tomorrow if you can. See you guys later. Bye.